One stock just cracked today's top 5 for June 30th. Uber. Uber is down 4.4% today and trading nearly 30% below its 52-week high, a grinding retreat that has a lot of investors nervous. But here's the story behind the story. Uber just announced that Lime, the ride-sharing company it backs, just pulled off a $167 million IPO in the US. So the question is clear. Is Uber a hidden strength play with successful exits in its portfolio, or is this Lime win just a distraction from weakness in Uber's core rideshare business? Let's break down the chart, the options market, and what the data is really telling us. The price is $72.16, and the 50-day moving average sits just above it at $73.36. That is a rolling over short-term trend, meaning buyers have lost control on the day-to-day timeframe. The 200-day moving average is much higher at $81.36, so the intermediate trend is clearly down. The nearest support is $67.19, about 7% lower. The resistance is $77.76. Why this matters now? The tightness between current price and the 50-day MA means Uber has almost nowhere to go sideways. Either we recapture that MA and re-establish uptrend, or we roll through support and accelerate lower. There's no quiet consolidation here. It's a make or break zone. RSI is 49.3, that is right in neutral territory, neither overbought nor oversold, which means we're not in an extreme setup yet, and there's no statistical reason to expect an immediate bounce. But look at the distance from the 52-week high. We're down 29.2%, that is meaningful weakness. Why it matters now? This isn't panic capitulation, which would show up as RSI below 30. It's grinding deterioration. Buyers aren't extinct, but they're not stepping in aggressively either. This is the dangerous middle ground where reversals are rare and downtrends can accelerate. The Lime IPO is clearly a positive. Uber's bet is paying off, and the fact that Lime can raise $167 million at a good valuation proves the mobility ecosystem is still attractive. But here's the risk. We don't have an earnings date in the data, and the thesis is flagged as unavailable. That means Uber's own growth story, margins, and guidance are off the radar right now. If Uber guides down, or if macro uncertainty worsens, the stock could drop through $67 support fast. The Lime win is a nice side story, but it doesn't fix Uber's own business if it's slowing down. Put-to-call ratio is 0.461. That means for every dollar bet on puts, roughly $2.17 are bet on calls, which is very bullish options positioning, indicating smart money still expects more upside. Now, the ATM implied volatility is at 46.88%. That is elevated. Options are expensive compared to their historical ranges, which means buying calls or puts here costs more than usual. Why it matters now? The bullish put-call ratio suggests conviction among options traders, but the expensive options imply the market is pricing in a big move. So you're paying more for the upside bet, even though the odds favor it. The verdict is watch with a down direction and LOW conviction, meaning stay defensive, but don't short. The entry zone is $71.23 to $72.16, and note we're already at the top of that zone. So if you're buying, you're at maximum entry price, not a discount. The stop loss is $66.87, which is 7.3% away, and the targets are $77.55, then $77.76, then $107. The reward to risk ratio is 1.02. That is roughly equal risk and reward, not compelling. Why it matters now? This setup is not asymmetric in your favor. You'd be risking $1 to make $1, which is pedestrian. Wait for a clear catalyst or a hold at support before committing capital. Here's the summary. Uber is in a downtrend with no clear immediate catalyst or conviction. The Lime IPO is a bright spot, but it doesn't drive Uber's stock price. Options traders are bullish, but they're paying high prices for that bet. The chart is at an inflection point. Either recapture $77.76 on volume, or test support at $67.19. For now, the verdict is watch, not buy. Keep this one on your radar, but don't chase. Wait for the show me.